Every nation across the globe is encumbered by debt, with the United States owing nearly $40 trillion and Japan close behind with $9 trillion. Overall, the planet is indebted to the tune of $315 trillion, 3 times the entire global output. Yet, a startling paradox should unsettle you. When everyone owes money, whom do they owe? The answer defies intuition. Tracking the chain of creditors reveals a disturbing truth. Earth doesn't owe funds to any external entity. It owes money to itself. This elaborate system was deliberately crafted by 4 men, bankers spanning 3 centuries, who engineered a setup in which debt becomes perpetual, governments borrow endlessly, interest flows forever upward, and the architects of the trap profit from every payment, crisis, and bailout. This isn't a conspiracy theory, but well-documented history. Meetings did occur, signed contracts exist, and the mechanisms are part of the public record. Once you grasp how it was built, you'll realize that the $38 trillion in U.S. debt isn't an unresolved problem, but an embodiment of the system functioning precisely as intended. Let me introduce you to the 4 key architects, moments in history when the debt trap was intentionally constructed, and why every government now finds itself ensnared with no escape. Before the year 1694, monarchs borrowed in the old-fashioned manner, approaching merchants or nobles, promising repayment with interest. If they failed, defaults ensued, and creditors endured losses. The king would then seek a new lender, containing the risk, keeping debt temporary and manageable. The system worked efficiently. Debt was either repaid or defaulted, and the cycle reset. Everything changed in 1691, thanks to William Paterson, a Scottish merchant and financial schemer who attempted repeatedly to attain wealth. During England's war with France, King William III desperately needed funds. The treasury was drained, and tax revenue couldn't cover the costs. Traditional lenders were wary, having defaulted before. Paterson approached the king with a bold proposal. He would assemble a group of wealthy merchants to lend the government £1.2 million, roughly $300 million today. The innovation was revolutionary. This loan would never be repaid. Instead, the government would pay interest forever, 8% annually. To regulate this arrangement, Paterson proposed establishing a new institution, the Bank of England. The mechanics were groundbreaking. Merchant lenders would deposit their gold with the bank, which would then lend it to the government. The government would pay interest annually from taxes, and the bank would distribute that interest to the lenders. The critical detail, the principal, or the original loan amount, would never be repaid. The debt was now permanent. Why would merchants accept such an arrangement? Because the interest payments were guaranteed by Parliament, backed by the government's taxing power. As long as England could tax its citizens, the interest would consistently flow, creating a perpetual income stream for those holding the debt. In 1694, a groundbreaking financial innovation transformed the way nations managed their debts. The lenders received banknotes in exchange for their gold, notes that became as valuable as money, so much so that they paid interest, making them even more desirable. Parliament approved this scheme, leading to the chartering of the Bank of England, with merchants supplying gold to fund the government's wartime efforts. This marked the genesis of a permanent national debt, no longer a problem to be solved, but a permanent fixture of the financial landscape. What is often overlooked is why this arrangement was so advantageous for bankers. The government committed to paying an 8% annual interest on a sum of £1,200,000, equivalent to £96,000 every year, in perpetuity. Essentially, the merchants had purchased an annuity from the state, a steady income stream contingent on the survival of England and its ability to tax. The banknotes, backed by this debt, were transferable, allowing their owners to sell them at will. Debt that could change hands but could never be fully repaid. The real stroke of genius, however, lay in what followed. The Bank of England was empowered to issue banknotes backed directly by the government's debt. Printing paper money up to the value of the loan effectively created currency out of debt itself. The government's IOU, once a simple debt instrument, became the very raw material for the nation's money supply. The more borrowing that occurred, the more currency was forged from debt, an endlessly expanding system. This template, governments borrowing without ever repaying principal, paying interest indefinitely, and inflating their money supply, is a marvel if you're a banker, but a disaster for taxpayers, who shoulder the perpetual interest on inescapable debt. Within half a century, this model spread across Europe. France established its own version, the Bond General. The Netherlands, with its advanced banking system, formalized government debt issuance. By 1790, the newly independent United States adopted a similar paradigm, with Alexander Hamilton explicitly shaping America's financial framework on England's model: permanent debt, taxes funding interest, bonds as currency. Despite Patterson's death in 1719, not particularly wealthy, the system he initiated endured for over 3 centuries. The Bank of England still exists today. Its debt never fully paid off. Instead, it's constantly refinanced, rolled over, and expanded, never eliminated. The debt trap was set in 1694, and every government since has entered willingly. By the early 1800s, Europeans embraced this model eagerly. They borrowed to fund wars, infrastructure projects, and daily operations. Yet, the market for sovereign debt was unorganized, with loans negotiated individually at variable interest rates, predominantly accessible only to the wealthiest merchants. It was Nathan Rothschild who revolutionized this process. Starting as money changers and traders in Frankfurt, by 1800, the Rothschild family had established banking houses in 5 major European capitals: London, Paris, Frankfurt, Vienna, and Naples, creating an unprecedented transnational financial network. Their ability to move funds across borders swiftly enabled them to dominate sovereign debt issuance, solidifying their influence over European finance. Nathan Rothschild in London emerged as a master strategist. During the Napoleonic Wars, he orchestrated loans for Britain, but his innovation was how he structured these financial arrangements. Instead of lending directly to the government, he would buy government bonds at a discount and resell them to investors at a profit, effectively creating a secondary market. This approach allowed the government to access funds instantly through Rothschild, who then sold bonds to pension funds, insurance companies, and wealthy individuals. The government received its money rapidly, Rothschild profited from the margin, and investors gained a tradable asset. However, Rothschild's influence extended beyond merely financing governments. He cleverly positioned himself so that nations had little choice but to seek his services. In 1815, at the Battle of Waterloo, Rothschild reportedly learned of Napoleon's defeat before the official channels in London did. His extensive network was faster, and he exploited this advantage to manipulate the bond market. By selling British bonds to signal that Britain was losing, he caused prices to plummet, inciting panic among investors. Once the market crashed, Rothschild bought vast amounts at rock-bottom prices. When news of Britain's victory finally arrived the next day, bond prices soared, and Rothschild amassed a fortune, not from insider trading, as we might understand it today, but from controlling information and timing market moves. This strategy established the Rothschild model: control information, control issuance, and dominate the market. By the early 1800s, Rothschild's influence over European sovereign debt was overwhelming. Governments seeking to borrow relied on him because he controlled the investor network, set the terms, and dictated the flow of funds. This is crucial to understanding the debt trap. Prior to Rothschild, governments could, in theory, refuse to pay, causing creditors to lose money and resetting the system. But Rothschild's innovation made debt a globally tradable web. A British bond could be owned by a French investor, resold to a German bank, and used as collateral elsewhere, creating a web so interconnected that defaulting on one obligation could threaten the entire international financial network. The innovation? Making debt so entwined that default would trigger systemic collapse, making it effectively impossible. As a result, governments became ensnared. They had to keep paying interest and borrowing just to service old debts. The debt, once permanent, became inescapable. By the mid-1800s, Rothschild's wealth peaked, richer than any king, benefiting solely from interest collected on sovereign debt. They produced nothing, built nothing. They merely extended credit to governments and profited indefinitely. The system Patterson envisioned in 1694, and which Rothschild refined by 1815, had become a perpetual mechanism of wealth accumulation fueled by debt. By the dawn of the 20th century, while European nations were ensnared in the debt trap, America was emerging as an economic powerhouse. Yet, its financial system remained rudimentary. Banks operated without coordination, money supply was anchored to gold, and there was no central authority to manage or control debt. It was J.P. Morgan who stepped in, not out of altruism, but driven by self-interest to safeguard his banking empire. In 1907, the nation faced a devastating financial panic. Stock markets crashed, banks failed, and credit markets froze. To save the system, Morgan personally convened the leading New York bankers in his private library. He locked the doors and compelled them to pledge their own funds to stabilize collapsing institutions. The strategy succeeded, ending the chaos, and Morgan solidified his position as America's de facto central banker. But he was well aware he couldn't perform this feat again. At 70 years old, he recognized the need for a permanent solution. Together with the most influential bankers, Morgan crafted a plan: establish a central banking authority. Yet, Americans, wary of centralized power after their experiences with the first and second banks of the United States, opposed the idea of a national bank. To circumvent this opposition, Morgan's team convened secretly on Jekyll Island, off the coast of Georgia, in 1910. Over 9 days, they meticulously designed what would become the Federal Reserve System. They kept the meetings clandestine because they knew public outrage would erupt if citizens discovered bankers were orchestrating the nation's monetary future. The stealthy plan was tactically brilliant. Instead of branding it a central bank, they called it a Federal Reserve System, comprising 12 regional banks. These banks would seem decentralized, overseen by a board of governors appointed by the president, appearing democratic, even public, masking the true control wielded by elites. In reality, the regional Federal Reserve banks were privately owned by member banks, which elected their boards. These regional boards then selected members of the Federal Reserve Board, with some government appointees, but the real power lay with the major Wall Street banks that controlled the New York Federal Reserve. This bank, overseen by Morgan's associates, held the critical authority to issue currency and purchase government bonds, effectively giving private banks the ability to create money. Passed by Congress in December 1913 amidst widespread ignorance of its implications, the Federal Reserve Act sparked an expansion of the debt trap. Now, the government's borrowing was no longer limited by the amount banks could lend. The Federal Reserve could create unlimited money to buy bonds, increasing the demand for government debt infinitely. Prior to this, borrowing caps constrained government borrowing. Now, the Fed's ability to generate money meant the U.S. could continually issue bonds without explicit repayment constraints, fueling perpetual borrowing and debt accumulation. The debt is recorded on the Federal Reserve's balance sheet, backed solely by the solemn promise that taxpayers will forever service it. This is the vital mechanism that sustains endless debt, ensuring there's perpetually a buyer for government bonds and unwavering demand. With the Fed guaranteeing these purchases, the government can borrow indefinitely, rolling over debt endlessly because there's always a willing buyer. Meanwhile, the interest payments flow from everyday taxpayers to the banking institutions that control the Federal Reserve System. Morgan passed away in 1913, the same year the Federal Reserve was established. His enduring legacy is the structural framework that underpins the staggering $38 trillion U.S. debt. Absent the Federal Reserve, the government could not sustain borrowing at such magnitude. Markets wouldn't bear it. But with the Fed acting as a steadfast buyer, the debt's limits vanish, transforming the system into an infinite trap. By the 1970s, this debt trap, originally engineered by Patterson, Rothschild, and Morgan, had become a global operation. Every advanced nation borrowed, continually rolled over debts, and paid interest. However, these nations often borrowed to finance infrastructure, and many struggled to meet their obligations. The trap was nearing its breaking point until Paul Volcker elevated it to permanence. Serving as Federal Reserve Chairman from 1979 to 1987, Volcker faced a crisis. Inflation exceeding 10% was eroding American credibility, and foreign governments were losing confidence in the dollar. To conquer inflation, even at the expense of recession, he sharply raised interest rates. In a historic move, the federal funds rate soared from 11% to 20%, stopping inflation cold. But this move also had deadly repercussions. Many developing nations had borrowed billions during the low-interest 1970s, and now, with rates tripled, repayment became impossible. Mexico owed $80 billion, Brazil, $60 billion, Argentina, $40 billion, and the interest alone surpassed their export revenues. In August of 1982, Mexico declared it could no longer make payments, defaulting on its obligations. This default threatened to ignite a global financial catastrophe. American banks, which had lent heavily to these nations, stood on the brink of ruin. Major institutions like Citibank, Bank of America, and Chase Manhattan faced catastrophic losses, risking systemic collapse. Volcker could have allowed the market to purge itself, forcing banks to absorb losses and clearing the system. But instead, he orchestrated a strategic bailout through the International Monetary Fund. The IMF extended loans to nations such as Mexico, Brazil, and Argentina, enough to service interest payments. These loans, dubbed structural adjustment loans, carried harsh conditions. Governments were compelled to cut budgets, privatize state assets, open markets to foreign investors, devalue currencies, effectively dismantling economic sovereignty, all to ensure the flow of interest. Importantly, these loans didn't reduce the debts, they merely perpetuated them, rolled over and managed, but never forgiven. This maneuver marked the true breakthrough of the Volcker innovation. When a nation can no longer repay its debts, it isn't simply forgiven. Instead, it's restructured, lending just enough to ensure continued interest payments, while extracting political and economic concessions in return. Over the past 4 decades, this debt trap has evolved into a tool of control. Countries unable to service their debts are coerced into opening their markets, divesting assets, and ceding sovereignty to foreign economic interests, all under the guise of maintaining access to borrowing. This pattern repeats endlessly. Greece in 2010, Argentina in 2001, Sri Lanka in 2022. Each cycle marked by IMF loans that sustain interest payments, impose austerity, relinquish national independence, and perpetuate debt, never truly paid off, only restructured. Even after death in 1999, Paul Volcker's legacy persists, an enduring mechanism ensuring the debt trap's global grip, making default impossible. Countries are continually refinanced into permanent indebtedness, with interest flowing outward, funded by the same banks, in the same institutions, and orchestrated by the same system that Patterson constructed in 1694. Let me reveal how these 4 architects built an unbreakable system, from Patterson's model of perpetual borrowing and interest payments, to Rothschild's innovation of making debt globally tradable, creating an interconnected web where default would collapse the entire system, and to Morgan's development of central banks that print money to purchase government bonds, fueling unlimited borrowing capacity. Finally, Volcker's tactic of restructuring instead of forgiving debt keeps nations perpetually ensnared, maintaining a flow of interest to the creditors. Today, the global debt stands at an astonishing $315 trillion, encompassing government, corporate, and household debts, all of which will never be repaid but only accrue interest, intertwined in a vast financial system where default in one place threatens collapse everywhere. Take the United States, which has issued around $38 trillion in debt. About $20 trillion of that is owned domestically by pension funds, mutual funds, insurance firms, banks, and the Federal Reserve, who purchase treasury bonds because they're deemed safe and pay around $1 trillion annually in interest. This interest is paid from taxpayer money, transferred from workers to wealthy institutions. The remaining $18 trillion is owed to internal sources, like Social Security and Medicare, money borrowed from these programs, spent, and ultimately still owed, meaning taxpayers are on the hook whenever these bonds are redeemed. Globally, the pattern persists. Japan owes roughly $9 trillion, mainly to Japanese institutions and the Bank of Japan. Europe owes over 14 trillion, mostly to European banks and the European Central Bank. Each nation's debt interconnected, creating a web where the flow of interest sustains a system that can never simply be unraveled. If the United States were to fully pay off its debt, the entire money supply would vanish, causing catastrophic deflation and economic collapse. Hence, the debt is kept permanently in place. This structure, born of Patterson's initial design, evolved through Rothschilds' international web, Morgan's money printing mechanisms, and Volcker's restructuring policies, ensures that debts are infinite, default impossible, and interest constantly flowing upward. It's a global system where none of the debts will ever truly be paid, and a small circle of powerful institutions reaps the endless benefits, transferring wealth from the many to the few under the guise of an inescapable, perpetual debt cycle. If you found this eye-opening, remember, understanding these mechanisms is crucial to seeing through the facade, because this isn't accidental. It's a carefully constructed system, one that benefits those at the top by controlling money, power, and influence, an economic trap built to ensnare indefinitely. If you enjoyed this exploration, please subscribe for more insights like this. Every nation faces mounting debt, with China's government owing substantial sums held by domestic state banks. This pattern isn't unique. Every country operates within the same tightly intertwined system. In global finance, nations are linked in a complex web. Japan holds American treasuries, while the United States owns European bonds through the IMF, and Europe in turn owes developing nations via the World Bank. It's a perpetual cycle. Everyone owes everyone else, and the flow of interest ascends to the institutions that manage this vast debt network. This system is inherently unstoppable. If the United States were to pay off its $38 trillion debt, the entire money supply would vanish, because dollars are created whenever the government borrows. Eliminating the debt would cause a catastrophic collapse, deflation, depression, chaos. Therefore, the government is compelled to keep borrowing, rolling over debts endlessly, and continuously paying interest. This global interconnectedness means that if every government tried to pay off its obligations, the world's money supply would shrink by about 2/3, strangling trade and halting economic activity. Debt, by design, is unpayable. It is a structural necessity, an intricate aspect of the system itself. The real beneficiaries are the colossal financial institutions that hold these debts: BlackRock, Vanguard, State Street, Fidelity. These asset managers command trillions of dollars, collecting interest from government bonds financed by pension funds, retirement accounts, and insurance premiums, about $1 trillion annually from U.S. debt alone, plus interest from Japan, Europe, and beyond. This relentless wealth transfer flows from taxpayers to bondholders, a vast, hidden form of wealth redistribution, often mistaken for taxes, where workers fund the interest that euros, yen, and dollars generate for elite investors. Central to this historical design are four key figures, living in different eras but each solving a problem in ways advantageous to the banking elite. William Patterson in 1694 made debt permanent. The Rothschilds made it global by the early 1800s. J.P. Morgan transformed it into an endless cycle in 1913, and Paul Volcker rendered it inescapable in 1982. Through their innovations, they built a system where governments continually borrow, never fully repay, and pay perpetual interest, benefiting those who control the debt, the financiers, not the taxpayers or governments. Most critically, this system thrives so long as confidence remains. If the U.S. were to retire its debt, the dollars created through borrowing would vanish, risking depression and systemic failure. To avoid this, the world's governments are forced into eternal borrowing and rollover. There's no escape. Their debts are not a crisis, but a meticulously crafted business model that sustains a global transfer of wealth, a mechanism where every dollar borrowed generates interest, money earned by a handful of powerful institutions. This cycle is the legacy of centuries of financial innovation. Each architect, Patterson, Rothschild, Morgan, and Volcker, crafted solutions that entrenched the power of bankers, transforming debt into an endless, global web. The result is a system where governments borrow forever, pay interest eternally, and the control over these debts lies squarely in the hands of the financial elite. And the truth remains, $38 trillion in U.S. debt, like similar debts worldwide, is not a malfunction. It's the foundation of an unbreakable machine that functions precisely as designed. As long as belief persists that governments can pay interest, regardless of whether they ever settle the principal, the system endures. And since the entire structure is interconnected, every effort to escape would risk tearing down the entire global financial edifice. If you found this illuminating, please stay engaged, and remember, understanding the true workings of this system is crucial to realizing who truly holds the power and who benefits from the endless cycle of debt. If you enjoyed this video, please subscribe for more content like this. If this shifts your perspective on government debt and clarifies that $38 trillion is no mere accident or oversight, but rather the result of a meticulously crafted system functioning precisely as intended, then you are beginning to grasp the true nature of power. If you wish to uncover how this intricate machinery was constructed and who actually controls it, knowledge they won't share in school, consider delving deeper. They promote the idea that debt is a problem to be solved. However, under this system, debt isn't a flaw but the very foundation itself. Interest becomes the rent we pay to inhabit their world, and understanding this reveals who benefits and who remains trapped.